You pulled up to the pump this week. You stuck your card in. And when the total hit the screen, some part of you wanted to scream. $80, maybe 90, maybe more. You did nothing wrong. You didn't make any bad decisions. You just needed gas. And somebody somewhere just reached into your wallet and took money out of it. And the worst part, you have no idea who. That changes today. I'm going to show you exactly what happened, step by step, dollar by dollar, from a military strike on the other side of the world to that number on your pump screen. I'm going to show you who is getting obscenely rich from the same event that's draining your bank account. And then, and this is where it gets interesting, I'm going to show you how to stop being the victim and start being the one on the right side of this trade. But first, you need to understand something that nobody is explaining on the news, something called the Strait of Hormuz. And once you understand it, you will never look at a gas pump the same way again. So let's start with a number. 20 million barrels of oil every single day. That's how much crude petroleum flows through a stretch of water so narrow that you could drive across it in about 25 minutes. 21 miles wide at its tightest point. 2 navigable lanes, each about 2 miles across. And through those lanes, every single day, moves roughly 20% of the world's oil supply. That's the Strait of Hormuz. And until about 2 weeks ago, most of you had never heard of it. Here's what you need to understand about oil markets, because nobody explains this part. Oil is priced globally. Your local gas station doesn't buy oil from Texas and sell it to you at the Texas price. The price of every barrel of crude on the planet is set by a global market. And that global market reacts instantly and violently to anything that threatens supply anywhere. It doesn't matter that the United States only gets about 7% of its crude imports through the Strait directly. When 20% of global supply suddenly becomes unreliable, prices rise everywhere. Every refinery, every pump, every gas station on earth feels it, including yours. Now, here's the math that they're not putting on the news. Every $10 increase in the price of a barrel of crude oil translates to roughly 23 to 25 cents more per gallon at your pump. Before February 28th, West Texas Intermediate crude, that's the American benchmark price, was trading at about $57 a barrel. It briefly hit $120 in the days after the strikes. It's sitting around $100 now. That's a $43 increase per barrel. Do the math. That's roughly $1.01 per gallon increase baked into every gas purchase you make right now. And that's assuming it doesn't go higher. So before I tell you what happened on February 28th, I want you to understand the mechanism. Because the news covers the event, I'm going to cover the system. The Middle East produces more oil than Africa, Europe, South America, and Asia Pacific combined. Think about that. More than all of those regions together. And the majority of that oil from Saudi Arabia, Iraq, the UAE, Kuwait, Iran itself has to get out through one place, the Strait of Hormuz. There is no meaningful alternative. People ask me, what about pipelines? Great question. Saudi Arabia and the UAE do have bypass pipelines, the East-West pipeline and the Abu Dhabi crude oil pipeline. At maximum capacity, they can move about 3 to 5.5 million barrels per day. The Strait moves 20 million. Even if you maxed out every pipeline, you'd still be short by 15 million barrels a day. You cannot reroute what the pipes don't have room for. There is no plan B at scale. And here's something almost nobody is talking about. It's not just oil. Qatar, the tiny peninsula nation that supplies 20% of the world's liquefied natural gas, has zero alternative route. Its LNG exports move exclusively through the Strait. That's why Dutch natural gas prices spiked 70% in a single week after the conflict began. Europe's energy security is partially sitting in that same 21-mile ditch now. Let me tell you what happened on February 28th. The United States and Israel conducted strikes on Iran. Supreme Leader Ali Khamenei was killed, ending a 36-year rule and throwing Iran into its deepest political crisis since the 1979 revolution. The Islamic Revolutionary Guard Corps, Iran's most powerful military force, did not wait. Within hours, they were broadcasting VHF warnings to every vessel in the region. No ship is allowed to pass. This wasn't a bluff. Within days, Iranian forces had attacked 10 ships in or near the Strait. 5 crew members were killed. Maersk, the world's largest shipping company, suspended all Strait crossings. Within 48 hours, more than 200 tankers and LNG carriers had dropped anchor rather than risk the passage. Brent crude, the global benchmark, spiked 13% in a single trading session. That was the biggest single-day move in 4 years, and the pump felt it almost immediately. In the first week alone, the average American gas price rose 48 cents per gallon, not over a month. In a week, diesel hit $4.83 per gallon nationwide, a 28% jump from pre-war levels. Now, I want to address something directly, because I know some of you are thinking it. You've heard that in June of 2025, there was another conflict with Iran, a 12-day war, and oil spiked and then came back down. So why is this different? Here's why. In June 2025, the Strait of Hormuz never closed. There were strikes, there was military action, but tankers kept moving. The market priced in fear and then priced it back out when the fear didn't materialize into an actual supply disruption. This time, Iran physically closed the strait. Ships aren't moving. Supply is actually being disrupted, not just threatened. That's an entirely different category of event. The market is not overreacting. It's responding to a real interruption. Let me show you exactly what this is costing you personally, because I want this to be concrete. The average American household has 1 or 2 vehicles. At the current price premium, roughly $1 per gallon above where we were 6 weeks ago, if you fill up a 50-gallon tank twice a week, you're spending an extra $100 a month just on gasoline. Not $100 more than last year, $100 more than 6 weeks ago. Annualized, that's $1,200. Gone. Not invested, not saved, not working for you, just gone, burned off through a fuel nozzle. If you're a small business owner, if you run deliveries, if you operate a fleet, if your livelihood depends on diesel, multiply that by 5 or 10. A commercial driver filling a diesel tank twice a week is looking at an extra $3,500 per year at current prices. That's real money. That's the cost of doing nothing. And here's the question I want you to sit with while I get to the second part of what I'm going to show you. That money didn't evaporate. It went somewhere. Every cent above the pre-war price is a wealth transfer from your wallet to the energy sector, to oil-producing nations whose reserves are now worth twice what they were 6 weeks ago, to energy companies whose profits scale almost directly with crude prices, to their shareholders. And the only question that matters financially is whether you want to be on the receiving end of that transfer or whether you're just going to keep funding it. Here's what's happening right now that nobody is telling you. The market is still pricing this conflict as short-term. Institutional investors, the people who manage pension funds, hedge funds, sovereign wealth funds, they're looking at energy stocks and saying, these haven't fully repriced yet. And $15 billion of institutional money has already flowed into energy funds in the past 2 weeks alone versus $2 billion in outflows from every other sector. $15 billion. That's not retail investors panicking. That's the people who know things, moving their money. And what they see is this: the supply disruption is real. The bypass capacity doesn't exist at scale. Diplomatic resolution could take weeks or months, and energy company valuations still don't fully reflect a prolonged $100 oil environment. But before I show you exactly what I would do, the specific tickers, the position sizing, the risk framework you need to understand one more thing, because I'm not going to let you walk into this without understanding both sides of the trade. There's a scenario where this ends fast: a ceasefire, a diplomatic resolution, a new Iranian government that reopens the strait. If that happens, oil could drop $20 in a day. It's already happened once in this conflict, XLE. The energy ETF I'll walk you through in a minute fell on March 10th when early diplomatic progress was reported. If you go into this without knowing that risk, you're not investing. You're gambling. So here's what I'm going to do in the second half of this video. I'm going to give you the exact plays, specific tickers, what they own, why they're positioned for this environment. I'm going to give you the risk framework, how much to put in, what your exit looks like if you're wrong, how to think about position sizing when you don't know how long a geopolitical crisis lasts. And I'm going to show you the second scenario, what happens to energy stocks if this isn't short term. Because Goldman Sachs and JP Morgan are already running those numbers. And the figures are not small. But there's something else happening that nobody in the finance space is explaining. This disruption doesn't just hit your gas tank. It hits everything that moves, everything that's made with petroleum-based inputs, everything that ships on a diesel-powered truck, your groceries, your flights, your heating bill. And I'm going to show you which sectors get crushed by a $100 oil environment, because knowing what not to own right now is just as valuable as knowing what to buy. The informed investor is not just buying energy. The informed investor is repositioning their entire portfolio for a world where oil is $100 and might go higher. Let me bring you back to where we are. The Strait of Hormuz is closed. 20 million barrels of oil per day, 20% of everything the world burns is bottled up behind Iranian Revolutionary Guard warnings and ship attacks. Your gas is more expensive. Your diesel is more expensive. And the money you're spending above the pre-war price is flowing right now into the accounts of energy companies and their shareholders. The question I left you with was simple. Do you want to keep funding that transfer, or do you want to get on the right side of it? Here's what I would do. And I'm going to be specific, because vague financial advice is useless financial advice. The first thing you need to decide is what kind of investor you are in this situation. Not what kind you want to be, what kind you actually are. Because there are two ways to play an oil price spike, and they are not the same thing, and pretending they are will cost you money. The first way is the ETF route. That's the right answer for most people watching this. The ticker is XLE, Energy Select Sector SPDR ETF. Let me tell you exactly what that is, because a lot of people buy ETFs without knowing what's inside them, and that's a mistake. XLE holds 22 of the strongest energy companies in the United States, weighted by market capitalization. Your two biggest positions automatically. The moment you buy one share are ExxonMobil at roughly 22% of the fund and Chevron at roughly 17%. Then ConocoPhillips at about 8%. Then you've got EOG Resources, Schlumberger, Pioneer, Williams Companies, and 15 more. One trade, 22 companies. Expense ratio of 0.08%. That's not a typo. 0.08% per year in fees. That's $3.84 a year on a $5,000 position. As of right now, XLE is trading around $57 to $58 per share. Its 52-week range runs from $37 to $58.22. It's up approximately 25% year-to-date in 2026. And $15 billion of institutional money has flowed into it in the past 2 weeks, against $2 billion in outflows from everything else. That $15 billion is the signal. That's not momentum traders. That's pension funds, sovereign wealth funds, endowments to people who manage hundreds of billions of dollars saying energy is underpriced relative to where oil is sitting. Now, the second way to play this is individual stocks. Higher risk, higher potential reward, and only for people who understand that they're making a more concentrated bet. ExxonMobil, ticker XOM, trading around $155. Here's why it matters in a $100 oil environment. ExxonMobil's Permian Basin operations, their biggest and most important production asset break, even at roughly $35 per barrel. At $100 per barrel, they're generating roughly $65 of margin on every single barrel they pump out of West Texas. They've committed $20 billion in share buybacks for 2026. That means they're buying back their own stock, which mechanically reduces share count and increases earnings per share. Wells Fargo recently raised their price target to $183. That's roughly an 18% upside from current levels. Chevron, ticker CVX, hit a 52-week high of $196.76 intraday, more geographically diversified than ExxonMobil, lower operational risk. If you want individual stock exposure, but you want the steadier hand, Chevron is that hand. And for the overachievers in the audience, the ones who want direct oil price exposure rather than equity exposure, there are commodity ETFs like DBO, the DB Oil Fund, or USO. These track oil prices more directly than energy stocks. The trade-off is they're more volatile, they have higher fees, and they don't benefit from the operational leverage that makes an ExxonMobil so compelling right now. Pure oil price exposure. Not for beginners, but it exists now. I promised you a risk framework, and I'm going to give it to you straight because I have no interest in telling you what you want to hear. Risk number one is the diplomatic resolution risk. This is real. If ceasefire is announced tomorrow, if a new Iranian government signals willingness to reopen the Strait, oil could drop $20 in a single session. That's not a hypothetical. XLE already fell on March 10th when early diplomatic progress was reported. The market is hair-trigger sensitive to any signal that the supply disruption is ending. If you're not prepared for your position to drop 10 or 15% overnight on a headline, you're in too much. I mean that literally, if seeing a 15% drop on your screen would cause you to sell in panic, reduce your position size until that number doesn't scare you. Because panic selling at the bottom of a geopolitical dip is how you guarantee a loss. Risk number 2 is the economic slowdown offset. Here's something sophisticated. Investors are already modeling. A $100 oil environment is inflationary. Inflation can force the Federal Reserve to maintain higher interest rates. Higher rates slow economic growth. A slowing economy means lower demand for oil, which caps the upside and can drag energy stocks down even if crude stays elevated. The market is already pricing some economic slowdown into the broader index. Energy stocks can get pulled down in a broad sell-off even when oil is high. Risk number 3 is concentration. Energy is 3.5% of the S&P 500. It's a small slice of the index for a reason. It's cyclical, it's volatile, it reverses fast. My rule, and it's been my rule for 30 years, is no more than 10% of your investable assets in any single sector. Not because I'm soft, not because I don't believe in the thesis, because I've watched people who ignored that rule go broke on positions they were absolutely certain about. Certainty is not a risk management strategy. So here's the framework in plain language. Take whatever you can afford to hold for 3 to 6 months without needing access to it. Put no more than 10% of your total investable portfolio into energy. Set a stop-loss alert, not an automatic sell order, but an alert at 15% below your entry price. If that level is hit, you make a conscious decision about whether the thesis has changed or whether the market is just noise. And if the war ends tomorrow and XLE drops 20%, you're not ruined, you're educated. And you know exactly what this mechanism looks like for the next time it happens. Now let me show you the second scenario. Because the bear case for energy, where peace breaks out and oil falls, is well understood. What the market is not fully pricing is the bull case. The scenario where this doesn't end in 2 weeks. Let me give you the supply math that Goldman Sachs and JP Morgan are running right now. The world consumes roughly 100 million barrels of oil per day. The Strait of Hormuz, when open, moves 20 million of those. The bypass pipelines, the east-west of the ADCO, max out at 3 to 5.5 million barrels per day combined. If the strait stays closed for a month, the world has to source roughly 15 million barrels per day from somewhere that doesn't exist at scale. Strategic petroleum reserves can cover some of that. OPEC nations outside the Gulf can pump some incremental supply. But there is no quick fix. There is no cavalry. Global electric vehicles are 4% of the vehicle fleet. That's it. 4%. They cannot substitute fast enough to matter in a 3-month supply disruption. The world runs on oil, and that doesn't change in a quarter. Iranian officials, and I want to be clear, these are adversarial statements, not neutral forecasts, have explicitly warned of $200 per barrel if the conflict extends. Now, I'm not projecting $200 oil, but here's the institutional math. If crude reaches $120, $130, $150 per barrel in a prolonged disruption scenario, ExxonMobil's Permian operations breaking even at $35 are generating over $100 of margin per barrel. The current stock price does not reflect that scenario. The current XLE price does not reflect that scenario. That's the window institutional investors are seeing. That's why $15 billion moved in 2 weeks. And now the part that I think is most overlooked, what this does to everything else. Diesel is $4.83 per gallon. Diesel powers the trucks that move every product you buy. Groceries, electronics, furniture, building materials, all of it rides on diesel. When diesel goes up 28%, shipping costs go up. And when shipping costs go up, the prices of everything that ships go up. This is inflation that hasn't fully hit shelves yet. It takes 4 to 6 weeks for a diesel price spike to fully work its way into consumer goods prices, which means the inflation you're going to feel in April and May hasn't shown up in March yet. The sectors that get crushed in a $100 oil environment, and these are the things you want to think about not owning or underweighting in your portfolio, are airlines. Fuel is 20 to 25% of airline operating costs. When jet fuel spikes, margins evaporate. The Jets ETF has already diverged sharply from XLE since February 28th. That spread is the market telling you which direction those businesses are going. Trucking companies. Any business that consumes oil as a primary input, any consumer-facing retailer with thin margins that can't absorb shipping cost increases without losing customers. Knowing what not to own is not a negative strategy. It's the other half of the same trade. If you're long energy and short airlines in your portfolio weighting, you've just built a position that profits from the same event on two fronts. Now, let me give you the exact next steps. Not the vague, consider speaking to a financial advisor language that tells you absolutely nothing. The actual steps. Step one, if you don't have a brokerage account, open one. Fidelity or Schwab. Both are free. Both have zero minimums. Both have excellent mobile apps. Fidelity has fractional shares, which means you can buy partial shares of any stock. Takes 10 minutes to open an account online. Step two, decide your position size before you open the app. Take your total investable assets, not your bank balance, not your emergency fund, your actual investable money, and figure out 10% of that. That's your ceiling for energy. Not because the thesis is weak, because 10% is the number that lets you stay rational if it goes against you. Step three, search XLE. Buy it. Set a price alert at 15% below whatever you paid. Step four, if you want individual stock exposure and you understand the higher volatility, add ExxonMobil, ticker XOM. Review the Wells Fargo thesis. Understand the Permian breakeven math. Know why you own it, not just that you own it. Step five, watch the news actively. This is not a set it and forget it position. Watch the Strait. Watch ceasefire talks. Watch shipping traffic reports. The thesis changes if the disruption ends. Have a plan for that scenario before it happens, not during it. And one more thing, because I know most of you are going to watch this video and not do anything. And I understand that inaction is comfortable. But let me tell you what inaction costs. Every week, the Strait stays closed. You're paying extra at the pump. You're funding the energy sector's profits without participating in them. You're watching $15 billion of institutional money move into a trade that you know about, that you understand, that you have access to, and choosing not to act on it. A year from now, one of two things will have happened. Either this resolved quickly, oil is back at $60, and XLE is flat or slightly lower from where it is now. In that case, you lost a small size correctly position, and you got an education in how geopolitical events move energy markets, which will be worth more than what you lost. Or this dragged on, crude stayed elevated, XLE continued higher, and you're sitting on a position that significantly outperformed everything else in your portfolio. Those are the two outcomes. One of them involves learning something. One of them involves learning something and getting paid for it. Neither outcome is catastrophic if you size the position correctly. I'm not a financial advisor. This is not personalized advice. You can lose money. Investing involves risk. Past performance doesn't guarantee future results, but this is what I see. This is what the data shows. This is what $15 billion of smart money is doing right now while you're watching this video. The question is what you're going to do when it ends. Drop the word pump in the comments right now if you're opening your brokerage account after this. I read every one. And if you want to go deeper, if you want to understand how to read oil price movements like a trader, how to think about commodity cycles, how to build a portfolio that doesn't get blindsided by the next geopolitical event, that's the next video. Because this won't be the last time the world does something that moves the price of oil. And the people who understand the system will always be better positioned than the people who are just reacting to the pump screen. Money never sleeps. Neither should your portfolio.